So the broad agenda of this meeting is I'll try and give you the overview of what the financial close process is. The financial close process itself has undergone a definition change over the last few years, so we'll try and cover what it entails and what is the role that financial consolidation has to play in the overall financial close cycle, and what are the steps that are being performed in what we call as financial consolidation. And then we'll focus about this particular cloud service that we are going to review today, which is Financial Consolidation and Close Service. This is a new cloud service that has been released by Oracle. So let's try to understand why the new service, what were the previous services, or what were the previous solutions that were in this particular space, and try and understand that. And then we will go into the functionalities. So once we go into the functionalities, I want to give you a brief overview about the data model of this application, which is very crucial for you to understand any other functionality in FCCS. Then we will go into dimensionality. We will discuss in length about security, because Siddharth tells me that security is of prime importance to you. And then we will also try to figure out the navigation in FCCS, what are the key configurations, how do we load data into FCCS, what are the different modes of loading data, how do we analyze data using something called as data forms, what is the actual consolidation process, how is it kicked off, what happens during a consolidation process, and few other topics, right? There is also something called as approval status. Let's try and see if we can cover that up in the session. There is a journal management module, which is what people use to enter topside journal entries into FCCS. Let us review that particular module as well. And then eventually we'll go on to auditing, which is very important from an auditor perspective. So auditing kind of gives you a report to brief everything that has happened within the application, whether it is a metadata updation or data updation and whatnot. And if we have more time after we finish these sessions, I am open to speak about those topics, even though I may not have content in the slides. Okay, I hope that makes sense. If there is any question on the agenda, you can let me know. Right, so financial close cycle. So financial close cycle is a subset, I would say, of the R2R process. So you must have heard about the record to report process, which basically involves collection of financial transactions which happens during a company's operations, right? So companies do their normal course of business over a monthly period, over a quarter, or over an year. All these transactions are recorded in transactional systems such as ERP, such as general ledgers. All your account receivables or account payables are all modules in your ERPs that record all the financial transactions that happen in a company. Now companies can also have complex organizational structures, right? They could be spread all across the globe. They could be in multiple countries, operating in multiple currencies, and all of that. Now the record process ensures that all these transactions are recorded in your ERP. But where does the financial close cycle start? It starts when you culminate all your organization's activities, which is nothing but closing of your subledger, posting all your accruals into your ledgers, and trying to reconcile the account balances that have been pushed into your general ledger, ensuring that these account balances have sufficient explanations in your subledger, and then transferring all this data which has been reconciled into your reporting systems, right? Now EPM are all reporting systems. Now this is where some data integration tools come into picture. Now in our case, in Oracle's case, there is a tool called as Financial Data Management, right? And in cloud it is called just data management. Now these are the tools that help you map the data from your transactional systems into your EPM applications. It gives you tools to map the dimensionality, it gives you tools to map the members of the dimension, and also it gives you tools to kick off the loading of data, right? So you close your subledger, you reconcile your ledger, you then do your data loading into your EPM applications, and after that is when consolidation comes into picture. right? You consolidate data across organizational structures. Now this subledger and ledger data may be owned by multiple subsidiaries, by multiple entities among your organization. Now during the process of consolidation, all this data from your multiple subsidiaries, multiple entities, profit centers, cost centers are brought into the EPM application and then consolidated to provide just one income statement or balance sheet or cash flow statement or whatever reporting needs that you have. This is where the consolidation of data happens. Right now, at that same time, there could be companies that are using external tax provisioning applications, right, where your tax calculations happen. Now, this tax liabilities are brought into the consolidation application, which is again taken into consideration before generating the financial reports. Now, financial reports can be of two types. One is management reports and one is statutory reports. Management reports are for your internal consumptions. Even companies that are not listed on stock exchanges, even companies that are not legal entities will have to generate management reports, whereas companies who are listed on the stock exchanges, they mandatorily need to generate financial statements in certain accounting principle standards, right? For example, many countries in the Europe mandate companies to generate their financial reports using local GAAP, IFRS GAAP, as well as US GAAP. So all these kind of reports can be generated after data has been consolidated in your consolidation system. Now let's look at closely on what exactly happens just within the consolidation application, right? Consolidation applications typically are multi-dimensional application. They have a multi-dimensional data structure. They define a common chart of account and hierarchy structures using multi-dimensional solution. And no matter which general ledger, which transactional system you are loading data from, it helps you map all the dimensionality into one common chart of account in your consolidation application. Right, so if you look at consolidation application, there is just one common chart of account. There is just one hierarchy structure that represents your entire organization. Now, what are the different things that happen? So the first and foremost thing that happens is currency conversion. Now, the subsidiaries, the profit centers, the cost centers in your organizational structure could be operating in different countries in different currencies. So there is a dire need for currency translation, currency conversion to happen so that you generate your reports in one single currency, which is the currency where your headquarters might be located. The second most important thing that happens is eliminating intercompany transactions. Now take the examples of brick and mortar companies, for example, a car manufacturing company. You can imagine the amount of transactions within subsidiaries of the company. For example, there could be a manufacturing there could be a factory located in region 1, whereas region 2 they might be only selling the car sales. It could just be a point of sales, right? Now there could be so many transactions happening between region 1 and region 2. Now if you try and report all these transactions in your financial statements, the financial statements will not be accurate because they will be bulged numbers, right? Those numbers are not a true representation of your business. So there is a need to eliminate intercompany transactions. And while all of this happens, there is also the ownership that comes into picture, right? Now there could be joint ventures that the company may be entering into. For example, Tata and Starbucks, they have a 50-50 joint venture in India. There could be joint ventures like Tata Steel and Tyson Group, right? So in such cases, not all the profits that were generated by your subsidiary is consolidated into your parent organization. Maybe only 50% of the profit needs to be consolidated in your parent organization. So the percentage consolidations are also taken care during your consolidation process. Now There could be a lot of transactions that were not recorded in your transactional systems in ERP, right? So those transactions will have to be adjusted, input in your EPM application. Those are called as topside adjustments. The journal functionality within your consolidation system is used to make sure those transactions are recorded in your consolidation application. And there are a lot of calculations that you'll have to do. For example, equity interest calculations, minority interest calculations. So all of this happens in your consolidation application. Any questions so far? Right? Now, what is the topmost goal of a consolidation system? There are two primary goals of a consolidation system. One is to reduce the reporting cycle. Now, if you are companies that are listed in the stock exchange, some stock exchanges mandate you to generate your financial statements 21 days from your quarter close, for example. So there is a time element attached to your financial close cycle. So the consolidation systems help you to reduce the reporting cycle time, right? Earlier days, people used to perform all these consolidation operations on Excel sheet, and the close cycle used to run almost up to 30 days, 40 days. Now, using the help of financial consolidation systems, that cycle has reduced to maybe 2 weeks, 15 days. So it's definitely reduced drastically. The second primary goal of your consolidation system is to deliver accurate reporting. Now, I'm sure most of you know that during currency conversion, the calculations get so complex that if you're doing all of this in Excel sheet, the numbers will not be accurate. And it's very difficult to track what calculation impacted which data. So consolidation systems help you not just calculating all your currency conversion, elimination and whatnot, but also gives you an audit trail to show you how these numbers are being calculated. Right? So I already covered about statutory reporting. I already covered about management reporting. Consolidation primarily involves roll-up of data along your entity dimension. I'll come back to the dimensionality of consolidation applications in a while, but all that you need to remember as of now is the roll-up of data only happens along the entity dimension, not along any other dimension. Some of the other items in this slide have already been covered, so I'm going to give them a skip unless anybody have any questions. I'm going to pause here just to check if there are any questions. All right. So coming to the new kid on the block, which is financial consolidation and cloud service. Now this is a cloud service that was released by Oracle maybe around 2 years ago. So it's a pretty new application in the market. And by the way, this is the 4th generation of consolidation application that has been released by Oracle and Hyperion, right? Hyperion was the vendor that Oracle acquired sometime in 2007. Before that, Hyperion had released 3 iterations, 3 versions of this particular software. Now, there are 2 reasons why there have been 4 generations of this consolidation application. One is the change in technology, and one is the changes in accounting regulations. Now, when you talk about change in technology, now they started way back in 1980 when we had only DOS-based applications. So they had something called as microcontrol. Then there was the desktop era where they built something called as Hyperion Enterprise. Then came internet era where web-based applications took prime importance. That is when they released something called as HFM, which was very successful in the market. Even as of date, there are 6,000, 7,000 plus customers who are using HFM for their financial consolidation needs. Right? And then over the last few years, we have seen that cloud has really taken in almost all the application space. Why? Because the capital expenditure is low, it's subscription based, even small companies can purchase it within a short period of time, faster time to market. You purchase it today, 2 weeks from now you can be live with the application, and if you do not like the application, you can terminate it within the end of the month. So there are multiple benefits of cloud, which is why Oracle has released the latest version of the cloud of the consolidation system, which is called as FCCS. Now, accounting regulations also have an important role to play for this different iterations of the consolidation system, right? So if you see, right from 1982, there have been multiple regulations that have been released by the international accounting standards as well as IFRS. Even as late as 2017, they mandated the way revenue is recognized. 2019 Jan, if I'm pretty sure all of you know that IFRS 16 is going to come into precedence, where all your operational leases are going to come into balance sheet. Now, all these accounting regulations also impact the way these consolidation applications are built. There are some additional capabilities that are added into the tools so that all these accounting regulations are supported. For example, to support IFRS 16, FCCS has another module called as Supplemental Data Manager, where you can record all transactional data and then do some calculations about your interest expense, about your depreciation, and then post that data into your multidimensional consolidation application. Right, so that is why there have been different versions, and FCCS is the latest consolidation application. Right, so any questions so far before we go into the demo? All right, so let's go into the demo. Now, the first thing that I want to explain is some of the concepts that will help you understand what a financial consolidation system is. Now, take the case of any consolidation application. It has three basic concepts in it. One is called the metadata, the second concept is called data, and the third one is called artifact. Now, data could be a number, right? So for example, what you see on the screen, 3689, it is a number. It could be a currency value. It could be rupees 3,689. But unless you describe it, it does not have any meaning, right? So we use elements, we use dimensions, we use measures to describe it. So in the example, if you see, I have added some measures, say actual, sales, London, January, so that it can add some meaning to that particular number. So what that basically means is January actual sales of cola in London are 3,689 pounds. So now it has some value for that number. What is the value? It says that during the month of January, the sales of cola in a particular region has been so and so. So the structural elements of the application that describe and hold the data is called metadata. And in consolidation applications, typical examples of this metadata are dimensions and its members. Now we will come back to how many dimensions are there in FCCS specifically, but understand dimensions are nothing but the structural elements that describe and hold data. Now the second concept that is there in the application is called data, right? Now data can be a currency value. In this example, it is a currency value. It can also be exchange rates. It can be percentage ownership. It can be ratios. It can be any of that kind. It can be any value that can be described by metadata. That is called data, right? Now dimensions, coming to dimensions, there is a hierarchy of dimensions that is built. It's not a flat structure. It is a parent and child relationship that helps you to manage data. For example, what you see on the screen is the account dimension with some hierarchy in it. If you see, sales is a child member and total revenues is a parent member. In consolidation applications, data can almost always be entered only at leaf members, meaning it can only be entered at sales. It can never be entered at total revenues, gross margin, or income before taxes. What happens is the data that you enter at the leaf members is aggregated into its parents. So for example, total revenues is nothing but the sum of sales and sales intercompany. Right? So aggregation happens. Parent and child relationship. Many of the dimensions within the consolidation application have hierarchies. Some dimensions, for example, the scenario dimension will not have a hierarchy. For example, the currency dimension will not have a hierarchy. But if you see account, if you see entity, if you see a product dimension, all of them will have hierarchy. And the most important hierarchy, I would say, is the entity dimension hierarchy, because that is what determines how data rolls up, right? Again, what you also need to remember is data is stored at unique combination of all dimension members, right? So as I already told, data can only be entered at the root nodes, at the child nodes, right? Now the unique combination of all child nodes of all dimension members is what will hold data, right? So I'll try to give a quick example using an Excel spreadsheet so that you understand this better. Let me open Excel. All right, so I'm just sharing an Excel spreadsheet to help you understand this better, right? So what you see now is the same data that we saw in the spreadsheet, but it will be stored in this way in the database. So you have, say, 1, 2, 3, 4, 5 dimensions. The dimensions are entity, account, scenario, products, and period. So in this case, the entity is Italy, account is sales, scenario is actual, product is cola, period is Jan, and the data stored against these dimensions are 100. Now imagine you had a structure, say Europe, and then the children are Italy and UK, right? Now that will be stored in the very similar way. Okay, let's make this cola, so the products are same. So what happens is the data for Europe is nothing but the sum of Italy and UK. So it is total and 200 is stored. So where the point I'm trying to make here is the data for Europe is aggregated because it is a parent, whereas the data for Italy and UK are basically input. It can be manual input, it can be input from a general ledger, or it can be input using a journal adjustment. Those are the three primary ways of data input within consolidation. So I'm just trying to explain where you can input data and how data aggregates to the parent members. I'll just go back to my slide.
How many dimensions does Oracle provide in FCCS?
11 dimensions.
That is as of release 13, right?
Can you repeat that?
That is as of release 13. 11 dimension as of.
Oracle releases cloud applications on a monthly basis. So what you have now, or the demo environment that you see now, is 16.06, I think. Sorry, 18.06, which is 18 stands for 2018 and 6 stands for June.
Okay.
Okay, so I'm sharing the PPT again, so hopefully you are seeing it. So during consolidation, the other important thing that you need to remember is that during consolidation, data rolls up only in the entity dimension. No other dimension it rolls up. It only aggregates in all other dimension. But consolidation happens only in the entity dimension. We will talk more about it in later part of the slide. And then we have a whole lot of artifacts within the application, which are basically used to manage the metadata and data, right? So I spoke about three concepts. I said that we have metadata, we have data, and we have artifacts. Artifacts could be data forms, it could be journals, it could be reports. Artifacts are used to manage metadata, manage data, or even just to view data, right? There is also something called a smart view, which is nothing but an Excel interface to view or manage data. So this is the concept that you need to understand in FCCS, and then all other functionalities you will be able to understand if you understand this one slide. Right, now coming to your question about dimensionality. Now we have 11 predefined dimensions in FCCS. Now if you see in the previous example, we saw that there is a dimension called scenario, we saw there was a dimension called period, entity, we saw accounts, we also saw something called as products, right? But in the actual system, we need many more dimensions to actually manage data. For example, in the previous example, we did not know which currency the data was represented in, right? So we need another dimension called currency to understand what is the currency of the data that we are analyzing. Similarly, we need a dimension for year. So Jan of which year? So to understand that, we have year dimension. Now entity dimension, I just want to repeat that this is where the organizational structure is maintained. When I say organizational structure, it need not necessarily be only legal entities. So legal entities are entities that are registered with the Ministry of Companies, right? The Ministry of Corporate Affairs, or in the case of UK, it could be the Companies House. They are registered there. It need not necessarily be listed on the stock exchange, but they are legal entities. The entity's organizational structure can also have profit centers and cost centers, right? Now a manufacturing unit is a cost center. Even that can feature in your entity dimension. And data can be loaded against that particular cost center, and it can be consolidated to some parent legal entity, right? And then eventually to the headquarters entity. And then you have accounts dimension, which basically represents your chart of accounts. The account structures that you'll have in account dimension could be statistical accounts, your income statement accounts, balance sheet statement accounts, cash flow accounts. It could be ratios. It could also be some exchange rates, right? I already spoke about consolidation dimension. This dimension helps you to track how the company is consolidated from child entity to parent entity. Right now there are multiple aspects that happens during a consolidation, which I already spoke about, which is currency conversion, intercompany elimination, proportional consolidation, which is nothing but applying your percentage ownership when you are rolling up data from a child to parent. So all that is captured in your consolidation dimension. It also gives you an audit trail, so you can really look at how the data is calculated, what is the data rolling up. Now intercompany is a dimension that helps you track all the transactions that are happening between two entities. Okay, movement dimension. Now this is again a very crucial dimension to capture all the balance movements of your balance accounts, right? Now balance sheet and balance account, as you know, are accounts that record data as of the time, right? Since the inception of the company, as of today, what is your cash balance, what is your asset balance. Now this movement dimension helps you not only track the activity against those accounts for a particular period, but also helps you calculate, for example, foreign exchange gains and losses. For example, CTA. It helps you track all of that. It also gives you the granularity to track movements of accounts against the classifications of your cash flow statement. For example, all the accounts that are impacting your financial activities, operational activities, investing activities. So it gives you the granularity, and the benefit of that granularity is that the cash flow statement is automatically generated. You do not have to do separate calculations for that, and this is one of the benefits of this particular consolidation application, which is financial close and consolidation. The prior versions of consolidation applications did not have this automated cash flow statement generation, for example. We also have the view dimension, which will help you track year-to-date numbers, right? It could be month-to-date, it could be quarter-to-date, year-to-date. It will help you track all those numbers. Data source again is another dimension that helps you track what is the source of data, whether it is manual input, whether it is a data coming from an external module such as supplemental data manager where you're doing all your operating lease calculations, or whether the data is coming from a general ledger, or whether the data is being adjusted to a journal. right? So these are the 4 broad categories of data that can feed into the consolidation system. This particular dimension helps you track that. Now these are, I think, 9 dimensions. There are 2 custom dimensions that are allowed. So you can have custom 1 as say product, custom 2 as department. But during the application creation, if you say that my application also has to track multiple set of books, meaning chart of accounts in local GAAP, chart of accounts in IFRS GAAP, chart of accounts in US GAAP, then one of the custom dimension is taken away for a predefined dimension called multi-GAAP. In that case, only one custom dimension will be available for you to set up a dimension of your choice. So this is the dimensionality of the application. Any so far so good? Now let's look at navigating FCCS and then get into some of the more complex topics. Now before that, I just want to show you how to navigate to the dimensions. Now in FCCS there are 2 kinds of user interface. One is called the simplified user interface. What you see in this screenshot is called simplified user interface, and one is the I would say the native interface. Now dimensions can be managed using both the interfaces. Not all functionalities are available in both the interfaces, but in this case managing dimensions can be done in both the interfaces.